Welcome back. You're watching Buy Now Sell Now from 18 Now SBI Live studio, and it's time to do a check on quarter earnings as well, and it's time to talk about Intellect Design arena. Revenue front 8% up quarter on quarter. Even the PAT is almost up 8.2% quarter on quarter. But then let's dive deeper in this. We have Mr. Arun Jain, Chairman and MD, Intellect Design arena. Hi, good morning, and welcome to the show. Let's talk about PAT. The figure is almost 94% year-on-year basis, 102 crores, and revenues up 34%, almost at 758 crores. Would like to understand what are the key growth levers this quarter?
Hello, I missed some communication link here.
Sure.
Can you repeat the question?
Not a problem, sir. I'll just repeat that. So I was talking about the growth levers that we saw in revenue as well as PAT. The numbers have come quarter on quarter as well as year-on-year basis. We've seen a jump.
Yeah, so I think the whole strategy what we put together in April 24, and we moved to the Europe and America as a market, and eMAG.ai becomes the centerpiece. The way beauty of eMAG.ai in understanding customer, where we put customer first design and operation first design in the front, is driving the change and acceptance of our product. And we forecasted last year that it will take 1 year for us to move to become acceptable by creating a reference site. And I think exactly it's working as per that, because there is too much pain in the legacy system, mainframe application in the global market. The market size is too huge for composable and contextual market. So this is driving the growth on one front, along with the Purple Fabric, which is my business impact AI platform. So both the levers are working simultaneously to see the outcome by the investor right now.
All right, but how's the sentiment with respect to the international geographies, specifically the US and the EU geography? What's the sentiment on ground, if you can give us some sense, and getting more orders, getting more repeated clients, what's the visibility there?
In US and Canada, the North America market is almost growing twice the market other markets are growing, and because I think they have a more legacy platform sitting there which they require to move to the cloud. So mainframe to the cloud is a bigger market opportunity, and for us, whether it's a Europe is concerned or America is concerned, who are in a bank tech wave 1 to bank tech wave 2 and 3, they are the most important player to migrate, and these deals are bigger in size, more sticky in size. My platform revenue has grown more than 200% in 1 year because of Central One acquisition plus our whole traction on eMAG.ai. These are the things which is driving us. So to us, US is a very, very promising market to us because we are not dependent on H1 visa, or we are not dependent on any of these things. We are participating in a core technology agenda of USA, and which is we are well positioned there.
So also you've guided for long-term growth by investment in your 7.2 lakh square feet facility in Suruseri. What timeline do you envisage for ROI and commercialization on this?
This facility is coming for co-innovation center with the customer of the eMAG.ai. This will take 2 years time to commercialize this facility. Maybe 18 months we'll start using some floors of this facility, which is in the part of the campus itself.
All right, but now let's touch on your margins as well. This time, very strong margins that we have seen. They have improved very smartly, but with the continued investments, how sustainable is the margin expansion? What's the outlook there?
I think we are in a product business. I think we have to explain the margin will grow because AMC grew 20%, 19% AMC growth, 200% my platform growth. So my incremental cost to service is much lower. So half year growth is 26% on revenue and 46% on margin. I think that element which I earlier suggested, 20%, we designed the business for 20% growth and 30% margin growth. That is a part of the embedded business design and model design, because over the period of time, product always give more profitability on my AMC and license link revenue. Now my license revenue has crossed 50%. This quarter we achieved license link revenue of 55% compared to license link revenue few years back was as low as 35%. So all the license link revenue drives the margin.
So let's talk about some risk factors and challenges. Are there any risks such as deal slippages, competitive pressure, or currency movement that could challenge the current outlook?
I think major deal shifting quarter on quarter is always a risk, and investor has to always discount that because they look at over the last 3 year period how what we are promising and what we are delivering, because investments are supposed to be in product company for long term duration. But looking at the overall risk in the company from today perspective, I think it's the risk is how much opportunity can we capitalize or not. Today we are cutting edge. We have a technology. Our R&D team has designed the technology which is at least 18 months ahead of my competition. Are we able to capitalize that 18 months period, the moat, and drive the noise in the market and acceptance in the market in the next 18 months? That is important for us to keep the pace so that we generate in next 18 months next level of technology to drive the change.
All right, we'll watch out for all of those triggers. But Mr. Jain, so good having you on the channel today. Thank you so much. It's been a strong growth for the company and definitely respected in the stock price, as well as the investors are also cheering the kind of strong numbers that you have posted. But thank you so much for taking the time out and speaking with us.
Thank you. Thank you.
From SBI Live Studios, and a lot of earnings are indeed trickling in. And let's move on and put the spotlight on MedPlus. This has been a steady quarter for the company. In the quarter gone by, we have seen a good number growth wherein the revenue has seen a jump of 7%. But look at the growth in their profit. It's a 43% bump up in their bottom line, and maybe one of the reasons why the stock is also very, very excited in today's trading session. But what's the outlook going ahead, and what are the factors that really help them perform so well? Let's understand all of that in detail, and let me welcome Mr. G. Madhukar Reddy, who is the MD and CEO of the company, joining us. A very good morning, and thank you so much for your time, Mr. Reddy. And firstly, great set of numbers coming in. And when I go into a deeper detail, I do understand that your pharma private label share, that has gone up to almost 12% now. The non-pharma private label, that has contributed close to 10% of your revenues. Help us understand what's the overall mix that you envisage for the company going ahead, and what are the plans there?
Thank you for having me. As in the past, I've always maintained that there's absolutely no reason why anyone should be buying branded medicine. All these products have been generic for years. The know-how of the making processes has been there. Almost everyone outsources them to different companies across the country, and we have the scale and size to be able to approach the best manufacturers and get them made for us. So it's just a matter of time. It will take a little while, obviously. We've been buying branded medicines for so long that it's not going to change overnight. We're very happy that within just 2 years, it has now gone up to nearly 12.5, 12.6% by sales. If you look at it by volumes, our private label pharmacy would probably be closer to around 25% of the overall medicines out there. So for us, I think we have taken on all the initial early adopters out there. We are now convincing the rest. It'll just take a little bit of time for us to actually grow there. That is what I think. But is there a cap? I don't think so. But is the speed of growth going to be defined by how fast the market changes? Absolutely. So maybe we'll start growing at around 1% or so every quarter. Last quarter, we did not grow, but that is for a good reason, because we had grown a lot in the couple of quarters before that. So we're kind of stabilizing it a little bit, but we'll continue to grow. On the general goods side, again, we currently have close to 5,000 stores. We are able to get almost every single product which we want, manufactured through great quality contract manufacturers. And given the fact that we are able to pass them directly to the customers, we are able to give them a great discount and all. And that's the reason why it has shown a steady increase. I don't see that stopping anytime soon. I think it will continue to grow. That's all I can tell you. Eventually, most of the stuff which we sell will be private label.
All right, Mr. Reddy, company opened 117 stores net in the quarter and 218 in almost first half of this financial year. Now, but do you believe the guidance for almost 600 store additions is what is given in FY26? Are you still sticking to that, or any new revision or a revised figure out there?
No, we have the property bank. I don't think it's going to be a problem. We will end up actually doing those stores. I don't think it's an issue at all. We will stick to the 600 stores. Yes.
All right, that will be interesting to see because in the quarter gone by, it's almost 117 store that you have added already. So 600 is the guidance there. But let's talk about your other division, that is diagnostic business. That has maintained profitability in the quarter. What are the growth plans here? Give us some more sense.
Diagnostics is going to be at a steady stage right now. We're not really looking to invest any more new money into that company. While it has, kind of become profitable and everything else, I'm still not happy with the way it has actually taken off. The goal was to bring us around 250 to 300,000 subscribers. As you may recall, ours is a model in which customer pays a small subscription fee or insurance kind of fee, and then he gets everything at almost cost to cost at around 80% discount and all. So it has been accepted. We have, gotten off to a reasonable start, but we have not yet reached the numbers we wanted to. Hence, we are just putting all growth on hold on that, at least on that model for a while. So steady state, but with nothing, and probably grow a little bit. We're still, looking to tweak something out there, which will allow us to get to that 250 or 300,000 subscriber base.
All right. Let's also talk about some traction in private labels now. What's the plan on adding more products, and what's the product mix, looking down few quarters down the line?
See, for medicines, we pretty much have the entire set of products right now. I think except for insulin and a few other products, we probably have almost everything which a customer would want. Obviously, next year we will end up getting the Wegovy and all those other GLP-1 drugs and all that, but that is going to be in the next year. Meanwhile, on the regular drugs, I don't think there's going to be a huge addition. It is where it is going to be. It will now involve us converting more of our regular customers from buying branded drugs into private label, and that's a function of the overall confidence and all which people will get over a period of time. On the general goods, though, there we continue to increase the number of products. I mean, there's a ever, I would say, increasing number of skincare, hair care, and all kinds of personal care products, along with health and nutritional products. Those continue to increase, and that's where I think we'll see the most amount of growth, both in terms of value of sales, as well as in the number of products which we put out there.
We'll watch out for that. Well, Mr. Reddy, with this, we'll let you go. So good having you on the channel today. Thank you so much.
Thank you very much for having me.
All right.
Welcome back. You're watching Buy Now, Sell Now from ET Now SBI Live Studio, and let's get connected to our colleague Anurag Joshi, who has a very important update. Balaji Wafers minority stake sale announcement may happen soon, as General Atlantic has signed an exclusivity agreement with the company founders. Now, ET Now learns GA has signed exclusivity pact to acquire less than 10% stake from Virani family, providing the PE firm an edge over rivals in the deal. Anurag Joshi has joined us with all the details. Anurag.
US private equity investor General Atlantic has signed an exclusivity agreement with the promoters of Balaji Wafers. This is a company whose valuation is said to be in the region of around 40,000 crore. And this exclusivity pact with the founders makes General Atlantic a front runner in the transaction, and it gives an edge to GA over other rivals in the deal. The sources have told ET Now that several PE firms had approached Balaji founders in the recent past to buy the equity stake. Balaji Wafers is a snacks maker, and its key product includes potato chips. The valuation is seen around 40,000 crore. This is according to reports. Now, just to give you a background about the company, this company is headquartered in Rajkot, Gujarat, and it was originally founded in the 1970s, but it was set up as a private limited company only in 1995. If we see the revenues for FY24, which is the last available data for revenues of the company, that was over 5,000 crores. And if this transaction were to succeed, this will be the second deal in the snacking industry after Haldiram. In March, Temasek and Alpha Wave Global Funds had bought minority stakes in Haldiram.
All right, thank you so much for getting us all those details, so interesting updates with respect to Balaji Wafers and the exclusive that we have got just for you. But moving on, let's put the spotlight on the telecom major Bharti Airtel, slated to report its numbers today. But what is the street really penciling in? Let me take it across to Mansi for all the details. Mansi.
Absolutely. Telecom major Bharti Airtel is set to post its quarterly numbers on the 3rd of November, and the expectations are to see a growth in terms of revenue to around 1.8% on a quarter-on-quarter basis. India Mobile Services also would see a growth of around 1.2% on a quarter-on-quarter basis is what we expect. Of course, driven by subscriber addition, while the average revenue per user growth would remain moderate. We need to keep a check on that number when the results come out. But at the same time, stable expectations on the margins front. The expectations are for the margins to stay in the range of 56%. It was the same in the last quarter as well. Internet coverage, we are expecting a steady revenue growth, and telecom with moderate ARPU, average revenue per user rise. No tariff hikes could see a healthy growth in the profit. Expectations are to see a 13% quarter-on-quarter growth in the profit terms, from 5,948 crores to 6,739 crores is what we are expecting. Of course, good performance from Airtel Africa after the tariff hike in the last quarter is something which we need to watch out for. And apart from that, a few key things and monitorables, and the capex outlay for FY26, which we'll be watching keenly. The progress of 5G implementations, commentary on mobile tariff hike and market behavior, as well as India versus Africa performance. On the whole, we expect Airtel to post decent set of numbers in terms of revenue and good rise in terms of profit.
Thank you so much, Masi, for all those updates. But then let's move on. The much awaited another round of stake sale of LIC by the government is likely to get delayed, as sources tell ET now that Deepam would wait for the stock price to stabilize near or above the IPO price. Prakash Pradarshi is here with more details. Prakash?
Well, that's an important development coming in, as we are learning from our sources that LIC's stake sale likely to be slightly delayed due to prevailing market conditions. In fact, the government may refrain from initiating the stake sale process until stock price improves. Sources tell us that the Deepam is expected to wait until LIC's stock reaches at least the IPO level, which is impacted by various reasons at this point of time. And therefore, Deepam wants a stock price to stabilize around IPO price band while the current price remains below that level. And therefore, government is taking all these factors into account before moving ahead. While sources suggest that the stake sale in LIC is likely by January 2026. However, road shows are expected to begin this month, where government is planning to sell a 2 to 2.5% stake in LIC through an OFS. A very significant development coming in. You were aware that the government had sold 3.5% stake in LIC through an IPO in May 2022, where it requires to sell another 6.5% stake in the company by May 2027 to meet SEBI norms. And therefore, government intends to sell the remaining 6.5% stake in the company in tranches within the deadline.
All right, thank you so much, Prakash, for getting us all those details. But back to the earnings projections then, and Tata Consumers too is set to report its numbers. This time around, it's expected to be a steady quarter for the company, but where all eyes will be on is going to be on their domestic business. Let me take it across to Snehi to help us understand what the street is really penciling in. Snehi.
Tata Consumer, the numbers are going to be out later today, and we're expecting to see a decent quarter on the consolidated year-on-year basis. Revenue is expected to come around 4,751 crores, which is an uptick of 13% on a year-on-year basis. But we're expecting to see an absolutely flat move from EBITDA and PAT, so not much happening on those fronts. Margins are expected to be under extreme pressure at 13.2% compared to 14.8% this time last year. So a sharp knock in margins is something that we're expecting to see. Overall, the India volume is expected to be around that 6% year-on-year mark. Tea volumes are expected to grow in mid-single digits, led by a price cut that they have seen, that they have undertaken in the tea segment. We're expecting to see a double-digit revenue growth in salt and a 9% volume uptick over there. So salts could do really well for Tata this time around. The India food business is expected to grow 20% year-on-year, with Sampann up 30%, Nourishco up 27%, and then most recent acquisitions of Capital Food and Organic India are expected to log in 20% and 30% year-on-year revenue growth as well. The non-branded business is also expected to do a 20% uptick on a year-on-year basis. And high single-digit growth is what we're seeing in their international business. So later today, when the numbers do come out, watch out for segmental performance in the domestic business. Any update on the number of stores and the growth trajectory for Starbucks? Watch out for their commentary on tea and coffee prices and the margin outlook. So keep a close eye on that. But well, yes, we're expecting to see a very muted set of numbers for Tata Consumer for Q2.
Right, so all about Tata Consumer, but then Snehi, Titan is also set to report Q2 numbers, and the jewelry major is set to see glittering earnings. What's the expectation like?
Well, yes, overall, we're expecting to see a good set of numbers from Titan's second quarter, in line with what the management had updated the street when they released their Q2 update. On a standalone year-on-year basis, if you take a look at the revenue, it's expected to come in around 14,964 crore rupees, which is a healthy jump of 13% on a year-on-year basis. Now, we're expecting to see very massive leaps in EBITDA and PAT. For EBITDA, we're expecting this number to go up by around 48%. For PAT, we're expecting the number to go up by 51% to 1,067 crore rupees. Now, if you wonder why there's such a massive jump in expectations on a year-on-year basis, remember there was a one-time reversal of the custom duty that the government had announced this time last year, the custom duty on gold, and because of which the base quarter was rather subdued. So any number this time around is going to show a very massive jump because the base quarter has been rather subdued. On the margins front, we're expecting to see a healthy show of 11.2% compared to 8.6%. And remember that 11% band is something that the management has always guided for, so it's in line with their guidance as well. In terms of the segmental performance, jewelry is expected to do well with an overall growth of 19%. Like-for-like growth estimated by brokerages is around 14% on a year-on-year basis. Tanishq, CaratLane, Mia, Zoya, they're all expected to do well. In the watches front, the performance could be slightly muted. The company has guided for 12% year-on-year uptick. The street was estimating 22%. Similarly, for eye care, the management has guided for 9% year-on-year for Q2. But the street was estimating slightly higher jump at 14%. So these could be the two segments that disappoint. Emerging business overall looks good with a 37% year-on-year growth, with fragrances, women's bags and Taneira doing well. But the real outperformer this time for Titan could be the international business, wherein we're expecting to see an 86% jump on the year-on-year basis. So when the numbers do come out later today, watch out for some metrics like their outlook on gold and diamond prices, the customer behavior in terms of the purchases they are making because the gold prices have gone up so much. Is there more demand for studded, for gold jewelry in lower ticket size, for more diamond jewelry? So watch out for that. And of course, their outlook on the wedding demand and the festive demand as well. So keep a close eye on all of these factors. But well, yes, when the numbers come out later today for Titan, we're expecting to see a good set.
All right.